right, good morning. Let's get on with it. Yeah. All right. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of helping you plan your trades and reducing your risk. Why? Well, trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. It's always a good idea to stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne McDonald. I'm a currency trader like you. I started my journey with the paper route. Then I worked at NASA. Worked at a nonprofit organization for a few years, running 27 different offices. Then I became a high-tech entrepreneur. Then I became a high-tech venture capitalist. And then I became a Forex trader. Cool. Right on. So here I am doing Forex for the last 20 years. Love it. Best thing ever. So let me know how I can help. I'm here to share my experience, good, bad, and ugly. I think there's always, well, if you're smart, there's always a lesson to be learned from your experience. And so I've learned a few things and I'm here to share. So ask questions, get involved, let me know how I can help. Now, many of you have asked for help over the years. You're like, Wayne, can you create a community? Yes. So I created FX Bootcamp. Then Wayne, will you create training videos? Yes. So I created 88 hours of training videos, like college lecture style stuff. Okay, not cyber babble nonsense. No, like college lecture type courses. 88 hours of that for $88 a year. People then said, hey, Wayne, can you write a book? So I wrote a book. Came out #1 in the Forex trading category 3 weeks before you could even buy it. So I appreciate that. That is there for you. The book is over 10 years old, but the lessons are valid. The data's changed, but the lessons are valid. I haven't changed the way I trade in those years. Anyways, people have asked, hey, Wayne, can you help with macroeconomics? And I'm like, yes. So I created Quant-in-a-Box. Your macroeconomic AI on the Google Cloud, helping you do macroeconomics. Yeah, it's there. Link is in the description below. Wayne, can you help me find a trustworthy, ethical foreign exchange broker? One that will treat me with respect. A broker that won't trade against me. A broker that will actually pay me my due swap. Yeah, tradersway.com. They earned my loyalty and respect, I think it was about 8 or 9 years ago, and I recommend them to you. Tradersway.com. The link is in the description below. If you don't want to click the link, don't click the link. I don't need to track you. You don't have to put like Wayne sent me. You don't have to put in a referral thing. No, don't worry about it, man. Don't worry about it. I don't earn commission, so don't worry about it. All right. I need to go. Yeah, we can stay here. I accidentally closed the chat window, so I got to pull that back up. Un momento, por favor. There we go. Favor says, hi, Master. Aussie dollar, I'm waiting for selling bearish. What is your analysis? Okay. You need risk off, macroeconomic contraction, preferably globally, for that to work out. I guess before we even go there, we got to go somewhere else. We got to go, let's go here. Let's go here. Okay, so you want to be a bear on Aussie dollar. And right now, Aussie is strong. US dollar is weak. So favor, it'd be like, maybe not this week, but certainly not now. John says, hey, what's the pair with the highest positive swap on Trader's Way? Well, even that, beyond just the highest swap, you probably want the highest tradable pair too. So, John, I would recommend something with peso on it. You probably want to buy the peso. I really like the Mexican economy. I really like the Mexican central bank. And right now they're paying 11% yield. So that's a beaut, John. So favor, in this moment, you could probably just put it on hold and find something better later. Does that make sense? Right now, based on Friday, there's still a bit of risk on mode. And Aussie strong, dollar weak, yen weak. That's all risk on. Kiwi rebound, CAD rebound. Okay? Those are commodity rallies, and that's risk on. So if you're waiting to short Aussie dollar, you got to have that fade from risk on to risk off. Okay? So you might have the right idea, but you probably have the wrong time. Let's take a look at the US dollar pairs. Okay, we are stuck out here. Oops, beep. Let me make this one click bigger. Okay, all right, so we're stuck here. Non-directional, in the middle of a range. So as of right now, I'm not really interested in anything. I think the only interesting thing about this for euro dollar is that this is sort of a risk on move here post FOMC / NFP. And I still think this is a pause play. So the pause is things can't get worse, so therefore only can get better, therefore risk on. I really think, despite a 99% chance of a pause by Jerome Powell on the June meeting, I think the Fed could still hike. So 99% says flat, but I still think they can raise. And that would be shocking because the entire market's looking the other way, and you'd get one of these moves. But that's not till June. And so even though what's priced in is priced in, the market kind of is behaving, not just the currency market, but even like the bond market. It's kind of like indecision. Right? Jim says it's now 12. It was 0%. Now it's 12%. And I was saying that even when it was 0%. So anyways, for like, Favor was asking about Aussie dollar short. You know, euro dollar, I think, would need to go with it. And it would end up looking something like this. As I describe in my book, Forex reverses like an old man easing into a hot bath. And that's what that would kind of look like. Can you envision that? An old man easing into a hot bath? Okay. So anyways, morning, A-dub or I-dub. Is one? Isaac. Okay, so anyways, look, Aussie USD straight up like a rocket ship. Great, 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 great. That's risk on. USD kitty cat heading down. Now this is much more interesting because if you believe they put a man on the moon, if you believe they put a man on the moon, man on the moon. Okay. This is interesting. First of all, it's risk on. Oil up. Okay. Risk on. Avert recession type play. And that's the annual high. Okay. So we printed that in March. And then we confirmed that investors are actually using these tools because then they came down to the central pivot. Then they tried again basically here. So now we know this is legit. Legit. It's French. Look it up. It's in the Geneva Convention. Legit. Okay. So now the next move is lower low, lower high. And by the end of the year, 122. Or lower. That's more than 1,100 pips away. It's one of those situations where I'm like, and you're trying for 30 pips. 30 pips a pop. You're like, 30 pips. So you could design a strategy that says every single day you're looking to add and compound trades to this one trading idea. Of course, if the trading idea stops working, you stop trading it. So if it's doing this, you're like, oh man, you never really get an opportunity to get back in. That's called risk management. And you're like, nah, not really want that. So you're like, I'm a risk on for this. I think the market's going to avert a serious recession. I think we bottomed out in oil. I think the United States stock market's going to do a lot better than what people are thinking. You think the Fed will pause, and by the end of the year, you do believe the Fed will cut interest rates because maybe whatever. So you put all that together, and all this means as long as USD CAD is making lower lows and lower highs, you're selling the rips. And maybe you can get 100 trades open slowly but surely. And to get 100 trades open, you probably have to make 300 trades, of which 200 of them basically break even. But at the end of the year, you've compounded 100 trades. Each trade has the maximum potential of hundreds and hundreds and hundreds and hundreds of pips times 100 trades. You're taller, thinner, better looking, funnier, smarter. Everybody likes you because you got 30,000 pips. Just a thought, food for thought. Just think about it. Okay, so anyways, that's kind of interesting. That's what this move means. So if it makes the lower low, lower high, that's a confirmation of that. We don't know if any of that's going to happen, so that's why you got to watch the markets and thread the needle properly. Pig dog, well, weak. Okay, weak US dollar means risk on. Okay. What this says right here off of non-farm payrolls, no recession. Okay. What this says here is no pause. Okay. What this says is no recession. Okay, that's just based on the dollar. And then compound from about here, it goes back to a BOE meeting in which they higher rates. They have persistent inflation over 10%, and they gotta jack those rates. Wait, did I put no pause? Sorry, I was thinking of a small town in Ecuador or something. No, pause. Sorry, pause. Pause. Recession. No recession. Pause. No recession. Sorry about that. All right, so that makes sense. Pause. So no more downward pressure on the stock market, rally. No recession coming because we still have 200,000 jobs a month being added to the economy. The economy is getting better and better. Okay, so no pause, recession, all that kind of stuff. But anyway, or pause, recession. Anyways, got to get out while I can. Got my losses. So anywho, rally risk on is what this says. And also the difference is not the absolute difference in interest rates. Okay. It's not the absolute, which means number versus number. Okay. Instead, it's relative. So the change in interest rates versus the change in interest rates. Okay, not absolute difference, relative difference. So let's say the Fed, so we'll do Fed this side, and we'll do BOE on this side. And so the difference for quite some time was the absolute difference, but now it's expected that nearly done, we'll just put done. So let's say 0% hikes, if not now, soon. But let's say people expect the Bank of England to raise at least 2.0 more. So now it's 2.0 versus none. And so now 2.0 is in favor, right? So anyway, so there's a lot of that going on. Up, 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 down, down, buy. 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 Up, 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 up. And this is somewhere around 27.5 is probably your take profit for the month / the week if we get up there. So that's only 100 pips left. But going back to favor, he's like, I want to sell Aussie dollar. Well, before you can sell Aussie dollar, you need pound dollar to come down. You need euro dollar to come down. Frank says, would CPI change everything? Yes. Obviously, it's one thing that we're watching, but we're watching that less and less now. So it's more like, how do we say it? We're moving away from that being the prime focus because we know it's come down from 10 to 5 and it's going to get very difficult to get from 5 to 3. But we're in that process. Everything that needs to be done on that front has been done. And if the Fed is pausing soon, if not now soon, then that whole inflation thing is complete. The cycle, the policy and everything is done. And we're waiting for the lagging effects. And the lagging effects would assume that we would slowly move from 5 to 3. So Frank, so then the next thing is, will the credit cycle adjust? So the Fed jacked up interest rates, and that makes borrowers borrow less. Okay, great. So we got to track that. But also, now that the banks are afraid, they want to loan less, which is the same as what the Fed was doing. They were trying to get people to borrow less. Well, now they're getting people to borrow less, and banks are now lending less because of the change in the market conditions. And so therefore, that's why the Fed could pause. They don't really care about interest rates per se. They're just trying to tighten the credit market. So if the banks now lend less and less and less and less because they decide as managers that the risk that risk is increased and they want to keep more cash on the balance sheet. So you see what I mean? So now they can pause, and as long as banks continue to tighten their credit, it's effectively the same thing. And so what we end up wanting to see down the road is that the economy starts slowing. So now we start looking again back towards GDP. Just a month ago, like before the banking crisis, I was like, why do you even care about GDP? Well, now we do care about GDP because now we care less about CPI, PCE, PPI, which, that kind of stuff comes out this time of month. It's relevant. And if inflation was way lower than expected, that would be, interesting, fundamentally relevant. If it was way higher, that's fundamentally relevant. But if it comes out like, kind of like what we thought, it's not really of interest. We've moved the target. Okay, the sniper isn't even really looking at inflation. It's not in the scope. No favor. No, I think on this account I'm on yen, dollar yen. So Alton is astute. Astute point, Alton. Alton says the loan officer survey will show some insight today. Yes, the Federal Reserve Bank of the United States of America, right? They are releasing this esoteric report that nobody ever cared about. Well, they're releasing it, and people now care about this thing. And it's how they get their measure of credit availability by their member banks. Now, in my quarterly outlook, for sure, but maybe even the annual outlook, I went essentially month by month, quarter by quarter. Let's say back in January, I showed you what I expect the market will do month by month, quarter by quarter for the entire year, 1 year in advance. And so one of the things we talked about is what are the concerns of the Fed for them to manage their policy. And then once we identified what the Fed cares about, I said, well, let's go look and see what's happening. And I was able, like one of the things I did is I went to the St. Louis Fed database and I generated my own chart of credit availability by banks. Like this, what we're talking about, where I actually generated and pulled the chart to show credit tightening. And we looked at that. And so that report is, the next report is coming up. So that data would go into the data set. And so you can track this, but we are on trend for credit tightening. So really, the Fed can tighten credit or the banks can tighten credit. And the Fed doesn't even really care. So yes, Alton, that survey comes out today. And yes, people are going to trade that today. So get ready for volatility in the banking stocks. Regional banking stocks are going to pop today. Up or down? Well, that's for you to decide. But they are going to move today. And one of the biggest things will be that bank manager survey by the Fed. Jim says, what do you think about more bank failures? You need to look at yields on treasuries. So I guess I should just bring up Quant-in-a-Box. Let's just Quant-in-a-Box.co. Hang on. So like, again, don't ask me what I think. Who cares what I think? Let's look at the facts. Okay, we'll just look at the facts. We'll get this bigger. Prosy. Those were the days. Who cares what I think? But we know what the problem is. Okay, the value of the bond portfolios has dropped significantly. So if bankers have to dump their portfolio, they're going to take a huge loss. All right, so is that in play? Glitch. Boo, glitch. I'll have to yell at the developers. What the? Is it going to be able to show us? That's too bad. That would have been a good. Is it glitched on both? I think I can get into retail as well. Those were the days. Oh, but retail won't have that. All right. So anyways, what I wanted to show you was when the banks started to get in trouble, the 10-year yield was 4%. Okay? And of course, it was at some point 0.5%. Okay? So imagine yields went from, let's say, 0.4, then it went up to 4.0. Okay? Wait, no, not is there? No, dude, like, hang on. See, it's hard for me to think and talk at the same time. All right, let's do it again. Okay, it went from, let's say, a half. I think it was 0.75. So let's do that. 0.75 up to 1, 1.0, then 1.5%. Okay, 1.75, 2. Okay, dot, up to 4. Okay, what's happening to the price? If banks were buying because there was nothing else to buy, they bought these 10-year T-notes, 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 they bought these 10-year T-notes. What's happening? Remember, there wasn't anything else to buy. The price is falling. If the yield is rising, it's because the price of these assets are falling. So imagine now banks have all of these assets. And the value of each one, especially the one at the bottom, is losing money on paper. Okay? So we get to 4.0 and these banks start to get into trouble, right? So now what? Well, currently, we're down to 3.5. Okay? So once we got to this 4% to 5%, depending on where on the yield curve you were on, I think the 2-year got close to 5%. So so since then, that was peak rates, peak yield. Let's say 5% on the 2-year, 4%. I think we're almost like 4.25 on the 10-year. So we've dropped, let's say almost 1%. Let's say, I don't think we got to 4.5, but we might have gotten 4.25. But let's just say the 10-year dropped from 4.5, and then the market started buying bonds. In particular, because they thought inflation has peaked and inflation is going to drop below 4.5. And if so, now they have very good positions of an asset appreciation, and real yields will improve because inflation would be lower, so you'd have a positive real return. So that's cool. So now that we're in this new, mode, let's say the technicals show that yields are falling, so prices are rising. And so the losses on this ladder of bond portfolio run by bank managers, they're losing less and less and less than they used to be. Good morning, Maida. So you see, like, am I expecting another bank failure? Well, things are improving. Things are improving. They're not as bad as they were before. And remember, a lot of these banks were in trouble a while ago. And it was because that upward move in yields were just killing these banks. But now it's been, 6 months since we've had that high yield. Okay. So it's not as bad. It's bad, but it's not as bad. Grind says blah, 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 blah. Whatever. You can't give me narrative like that without a full board presentation on how you got to that conclusion. So I'm not saying you're wrong, Grind, but like a statement like that in a YouTube chat is just empty, right? So I'm not saying you're wrong, but I'm like, you can't come in and say that. Like, no, I'm not interested in the opinion. I'm only interested in the facts, right? So yeah, that is one plausible outcome, for sure. Okay. So no disrespect. I'm just saying it's just the statement is like we were talking about this yesterday. Somebody said, oh, their buddy thinks gold is going to go to 10,000 by within 3 years. I'm like, that's just empty. It's just empty. I'm like, great. And the sky's falling and whatever. So you got to back it up. So I'm not interested. And I'm like, so one of the things we talked about was, okay, for that to occur, we need a certain set of, like, the variables have to be tuned. Multiple variables need to be tuned in a certain way to get that outcome. So the outcome is possible, but almost anything is possible. And some things are like blatantly not likely to happen, and some are relatively likely to happen, and some are much more certain to happen. So we're like, okay, if we were to tweak everything, what would we need to tweak, and in which way would we need to tweak it to get the outcome of $10,000 on gold? It's like baking. Okay, if you want a cheesecake or if you want a German chocolate cake, you have to have the right variables, and you got to set everything right. You got to get the mix right, and how much flour, what kind of flour, how much salt, how much eggs, all that kind of stuff. And we need cream cheese if you're doing a cheesecake, but if you're not doing cheesecake, then you don't need that. And so you're like, you just have to change all these mixes. And then the likelihood of getting an edible, enjoyable output, right? So if you want cheesecake, or if you want $10,000 on gold, you just have to have the right variables tweaked in the right way. And so we discussed like what would need to happen to have that happen, get gold to 10,000 in the next 3 years. And we're like, okay, that could happen. That's a variable, like that's a possibility. But we don't have anything like that now. So it's just sort of like empty air. Okay. Okay. Yeah, grind. I'm not saying not just like that's it. So I'm just saying like if we're in a different environment, grind, right? If we're in a different environment, you and I would just talk about it. That's all. And you're like, oh, so how do you get there? And you would explain it all out. I'm like, okay, that's cool. And I might throw in some questions. Well, what do you think about this? And what do you think about that? But, which is a different environment than just what I don't want. And I guess why I pick on it, grind, is there's lots of people that watch these videos that are still relatively new to trading and investing. And I think not you, but when people, or even if I did this, threw out these like opinions, I think it's dangerous because people don't know how to qualify the opinion. So I'm trying to stay away from the opinion. So if I don't tell people what I think, but I instead go through facts and try to teach how to synthesize the facts to come out with some sort of conclusion, and then somebody else in the chat just puts out a pure opinion with no facts, then I fear that's a little dangerous. So I don't want people to grab onto something, right? I want them to listen to my lessons. So, right. But if you and I were able to have an intellectual conversation about it, then it's fair game, but you would have to back it up. And, and you probably can back it up. Great. Cool. But one of the things I teach all the time in the day trading group, the swing trading group, is like, show me your facts and then give me the opinion. Don't give me the opinion first. So we literally last night were talking about building a PowerPoint slide deck that clearly outlines with facts how you get to your fundamental bias for each individual currency. And show me how this gets to a strategy. So for sake of argument, we said, okay, let's say you build a slide and it gives 5 bullet points why you want to sell the Japanese yen. Just in general, which means every opportunity there is to sell Japanese yen, you intend to sell Japanese yen. And every time the Japanese yen turns bullish, you back off and walk away. You're not swinging both ways like a broken gate. You have very strategic intent on what you want to do. Okay, great. So you got that set. You can prove it. You can discuss it. You can argue it. Most importantly, you can explain it. So you got that. And now the next question is, okay, if that is your strategy for the next, 6 months to 12 months, okay, fine. Okay, remember, it's based on logic. Great. So if you're selling yen, you have to buy something against it. What do you intend to buy? So now you've done the same thing. You've done the research on the pound, research on euro, research on CAD, research on Aussie, research on Kiwi, research on the US dollar, you research on the Swiss franc, right? You go through all these majors. And you've done now research for all of those, and you have a set of cards, basically. And once you have done all of that, then you can say, well, let's say the two that are my most favorite to buy would be these two currencies. And the two that would be my least favorite would be these other two currencies. Well, of course, this is what Quant-in-a-Box is doing for you. But you could still do it and still build a PowerPoint deck. But that's the idea, like, you have to have clarity intent. If you just open your charts, look for a bunch of trades, you're always behind the curve. And the problem with that is you'll never be able to compound, and you probably don't have the confidence because none of your trades are based on research. Your trades are based on looking for something to do. So you'll never have the confidence to let winners run. You just won't. So you're like, look at me. I'm awesome. I made 30 pips today. Good for you. Okay? You have no idea if that 30 pips was worth the 300. You have no idea. We just looked at what was it, pound dollar? I'm like, if this happens, then the target is 1,100 pips away minimum. Well, if you thought like that first, you could say, my strategy for the rest of the year with certain market conditions will be to target that goal, that goalpost. It could be 1,300 pips. It depends on where that next pivot is. But the thing is, if you then saw the market conditions were ripe for that pound dollar to drop well over 1,000 pips, then that would be your strategy. And then from then on, tactically, your day trades, your swing trades, and your position trades are all focused on capturing that move. But now, because you have a strategy behind you, there's no way you would take a 30 pip profit. You're like, 30 pips on a 1,000 pip move? Are you nuts? So you're jamming stops and letting them run, man. Okay? Okay. Morning, Sniper. So anyways, you see, like, I'm trying to give you positive messages. I'm trying to push you into more of an institutional process of developing your trading strategies. Okay. I'm sure if I burn through these charts on a 15-minute time frame, we'd just find a bunch of crap to do today. But on the long run, all of it would be irrelevant. And 95% of retail traders that do that fail to make any money on the long run. So like, why don't we just stop that process? Why don't we break those old habits and develop something much more sustainable? Volatility is not sustainable, right? That oil dropping $20 and then 2 days later is up $20. Dude, that is hard. If you're all over the place trying to chase that, that's difficult. But if you're holding the line, you can have fallback positions that you defend, and in the right technical conditions, like oil, let's say oil drops $5 in a day, but then falls on likely support and you're a bull. Well, if it gives you a reversal pattern there, you can try to get the up. Oh, but it collapses again. Oh, well, you fall back to the next line, the next support, And you're like, okay, well, is this going to hold because I'm a bull? You're sitting around waiting for a reversal. Nope, doesn't reverse, drops another $5. Wait. Where's the next level of support? Then you get it, pops, make a higher high, buy the higher low, and game on again. But if you're trading both ways, it's very difficult to be consistent. Liquidity? Why would liquidity be a problem in Forex grind? We are liquid. It's money. Okay. And volatility is bad for consistent returns is what I'm saying. So you got to put it in context. I'm not saying it's too volatile to trade. It's too volatile to get consistent returns. If it's crazy bearish one day and crazy bullish the next day, that's inconsistent. So to get consistent results out of that with long-term asset appreciation versus just short-term gains, okay, yeah, sure, you might be able to scalp the heck out of it, but you will not get consistent returns. Oh, well, okay, grind. Okay, I see what you're saying. Okay, and then we'll move over and we'll look at that now. Okay, I see what you're saying, grind. So here's what it really is, grind. I mean, I know what you're saying, and I don't disagree. But I think what you are actually saying is that amateur traders are over leveraged. Yes. And so you have inexperienced people, very often have no education in the terms of economics and finance and the mathematical mechanics of investing and trading, right? They come in and they don't got no much money. They need to get rich quick, and they have no idea what they're doing. And guess what? They're over leveraged. Yeah. It's the over leverage. And by leverage, I don't mean 100-1 versus 200-1 or 50-1. What I mean is you have $10,000 in your trading account. And for many people, that's a lot of money. So maybe less than 10,000, but they're trading like standard lots, right? They might have 10 times the amount of leverage that a hedge fund has, right? Yeah. Oh, and grinds is a $10 account I don't know anything about that. Like, yeah, I can't. That's. I mean, I don't know. Yeah, I don't even know what that is. A $10 account. I don't know what that means. I mean, a $10 account. Yeah. Yeah. Well, I honestly, I don't even know that game. I don't even understand the logic of it. But, okay. But yeah. Yeah, that's funny. In my mind, I'm thinking people starting with 1,000 to 5,000. Usually what I say is lower your leverage, focus on learning the game, focus on getting a couple of years of experience, learning both the fundamental side and the technical side, and work nights and weekends to save money. Don't invest it now. You can have a couple of grand while you're getting experience, but build your capital stack over the next couple of years while you're learning. So imagine how good you'll be, let's say in 2 or 3 years, plus you've saved some money for 2 or 3 years. So you won't be undercapitalized. You'll be in a better, let's say, mental, psychological, and financial situation to try to turn Forex into a small business. But $10, like, I can't even eat at a fast food restaurant. I can't get lunch for $10. So how do you build a career around $10? I don't think people with, I mean, I don't even understand it. So, yeah. So anyways. So, right. So get a job. And of course, people will say, well, Wayne, I live in a poor country. I got 9 kids. I already have a job, and I just don't have the time for nights and weekends or something. Look, you got to overcome that. It's not my fault. If all of those variables are true, well, dude, that's your problem and you need to fix it. But getting rich quick ain't the answer. Getting rich slow is the answer. Very few people get filthy, stinking rich quickly by gambling on crap they don't understand. Like, it just doesn't make sense. But I will tell you that when I went to Harvard for 5 years as a full-time student, working nights and weekends, and I mean every night and every weekend for 5 years, and even moving out of my home during the summer to live on campus, I am married, I have children, I have a job and a career and responsibilities, and I did that on top. I think you can do it. And let me tell you, Harvard was not easy. Like, it was very difficult. At some points, stupid difficult. So if I can do that, commit for 5 years and hundreds of thousands of dollars and raise kids and be a half decent husband and trade Forex and coach Forex, and like, dude, you can do it. But you have to be a tough son of a bitch to do it. And that usually determines whether you give up because getting rich slow, it takes too long and is too difficult. Then the dream was a mirage anyways. You have to be tough. You have to be disciplined. You have to be focused. You have to beat 5% of the market. So if you don't step up and be the top 5%, it ain't going to work. I mean, think about that, right? If 95% fail, then all you need to do is be in the top 5%. Now, I'm an entrepreneur and I'm like, top 5%, that's easy. But you need to be solid all the time. Okay? So anyways, that's what I would do. But yeah, but the $10, I don't know, that's like a demo account. Try it. But if you take your $10 account and then degenerately gamble it, like, hey, let's try this. Boom. Dude, fail. And I don't care. No, honestly, look, I was giving feedback to a trader who had, like, I can't remember the number now. It just blew me away. I'm like, let me look at your FXCM account. He has an FXCM account, right? I'm like, let me look at it. I want to look at all the past trades you've made in the last couple of months. So just let me log into your FXCM account. So he gave me the credentials. And it was like $50 million. I'm like, really? In your FXCM account? You're like, oh my God. And this guy was shit. He was one of the worst traders I've ever seen, making every classic mistake. And I'm like, dude, you're losing like a couple of $1 million a month. And these are terrible trades. And he's like, yeah. And for him, it was like a demo account. I'm like, whoa, dude. I'm like, come on, let's settle down. You're buying high, you're selling low. Like, really? So the amount of money doesn't matter. I don't care if it's $10 or $10 million. There's a right way to trade and everything else sucks. So pardon my French this morning. I know I have potty mouth. I'm tired. I've only slept a few hours. But dude, you either do it right or you do it wrong. And the longer you stay in the trade wrong camp of staying small, like I say, stay small, stay humble. I mean, like sort of attitude and stuff. But if all you do is pick up pennies, you never get to where you probably want to go. So one of the things I should probably do in a group kind of setting is we should probably just knock out a PowerPoint, an Excel spreadsheet, and we just pop in the numbers. We just do some mathematical calculations of a short-term trader versus a longer-term trader. Basically, a retail trader versus an institutional trader. And I'll just prove to you mathematically that you will not get to where you're going if you keep trading the same way that most retail traders trade. And by most, I mean probably at least 95% of them. So I'm like, I would hope to appeal rationally. And what you need to do, obviously, you start to appeal rationally and then you got to appeal emotionally, which emotionally it's way more important, but I think I would start this argument rationally where we would spend, let's say, 45 minutes to an hour. I build an Excel spreadsheet, and I just prove mathematically that it's not possible. What retail traders do does not lead to the get-rich-quick dreams that they have. Even if it's like, do that for long periods of time, what happens is you never get to that weird vision. You know, if you're like, I have $10, but I want to fly on a private jet, and I want to have a yacht with girls in bikinis, and right, and we're popping champagne, and woo, this is me. Well, it'd be very difficult to go from $10 to that. It's mathematically possible, but not likely, nearly impossible. But then we analyze the way that person is trading, and it's 99.999999999% impossible. But it is possible. You could do it, but then the behavior determines, and also the time, the amount of time. Okay. Well, Elm, right now my money is going into starting a new hedge fund, right? And an SEC-focused hedge fund, building portfolios of stock that lowers volatility in the overall portfolio, somewhat by buying lower beta stock, but also by using derivatives to lower the volatility. That's the first mandate. The second mandate is earn income. So you can either compound the account, even in down markets, your net asset value might be falling, ideally falling less than the market's falling, but still occurring high income, right? For retirement portfolios. So is it enough? No, I want to do more. And the consequence of me doing more is, I'll probably make some money doing that as well. So it's all good, my friend. It's all good. It's all good. Thank you for your concern about me. I appreciate that. So we go right back. This is the game we're looking at. So an update for gold puts us on red alert for selling. So that 2030 area is of importance all the way to about 2040. So bears are going to look at it this way. Okay. Right, Grind. Well, so the idea, look, Grind, if I'm managing portfolios in perpetuity, one of the things in the back of my mind is the net asset value of the initial portfolio. So that's the dollar value of the stocks you buy. Okay, the first thought is, what if that never matters? What if you don't really care about that because from today, in your opinion, between today and 2050, the stock market will generally be up. So then you look at this and you say, okay, well, then I don't really truly care about the net asset value, but I do want to hedge. Okay, so you do want to hedge, but also you want to reduce the volatility further by choosing particular stocks that that you would put in the construction of that portfolio, right? So now you want sort of a low beta, somewhat lower beta than the S&P 500, right? So you have to look at that and say, all right, so if I just bought the S&P 500 and held it to 2050, I think it'll be higher in 2050 than today. But then can I lower the the volatility further to be less than the S&P 500? Yes. Okay. So through lower beta and hedging. Okay. That would be that first thought, wouldn't it? How can I lower the beta and be hedged with the general idea? So, going here, I guess, do I want to go blank? No, let's go blank on a different one. Which one do I go blank? Let's go blank WTI. Blank. So the thought process is this. Over the last 50 to 100 years, the stock market goes up 2.2% a year. Okay? 2.2. And we call that potential. Usually a little asterisk means potential. So if I just hold on year one and I go to year 50, so let's say the next 50 years, well, based on what has happened in the past, this grows 2.2%. Actually, I'm thinking GDP. Sorry, this is GDP. It's 8%. Okay? So the stock market, whatever you mean by that, over the last 50 years has gone up 8% a year. Okay, great. So how do I get this, okay, in general? But at the same time, we know the stock market didn't grow like that. Okay, there's recession, there's productivity gap fills, then there's bubbles, and then you get this, and then you get this. And we call this now the business cycle, where there's periods of bust, boom, bust, boom, bust, boom. Okay, so now you're like, is it possible to do sort of like this, most of this, some of that, most of this, some of that, most of this? Because now you're like, not only do I want lower volatility, but wouldn't it be great if you took less downside and now be able to catch more of the upside? Maybe not all of it, but most of it. Well, hell's bells. That's yet a third question. So now you're like, you want lower volatility on the way down, but you don't want improved returns by removing the hedge, because the hedge is a mandate, but a hedge is like insurance. Look, you waste money, don't you? Don't you waste money every year by having insurance on your house? And you're like, dude, your house didn't burn down. You just burned your premiums, right? You just burned money for insurance that was worthless. Well, maybe you think house insurance is valuable even if you don't use it. You're like, one day you don't want to have your $1 million house burned to the ground. So is the hedge a waste of money, or is it a valuable asset? Right? But still, then if you're like, I want less downside, but as much upside, that's not a normal hedge. Now you got to like switch portfolios. Higher beta, but continue to manage volatility and maintain the hedge. And you're like, how do you do that? Well, there's portfolio shifts. So now what you're trying to do is stabilize your net asset value, because it doesn't matter if you have a little less downside here, great, and then more upside here, great, and then a little less, great, and then a little more upside, that's all right, great, great, great. And all you're doing is trying to get to where you think you're going, 8% a year growth, over long periods of time, but there might be years you're down to 10% and other years you're up 30. You understand? But on the long run, when you're too old to work, it'd be ideal if you got to the 8% per year with less valleys and as much peak as you can get without being exposed to bubbles and high risk unicorn investing, like all that degenerate gambling you want to cut out. So it's very, very, very active, right, Richard, to do all that? And then really my next mandate would be, okay, if the net asset value over long periods of time can still earn the 8%, I'm just doing what the market is providing. I'm not beating the S&P 500. I'm just getting the S&P 500 without as much volatility and risk. Trying to have the consistent returns, smaller losses, decent wins. Okay? But the consequence is you don't get as much upside, but I need to actively manage it so that you get most of the upside during the good times, but not by taking more risk. Okay? But then the next thing is, okay, that's great. So low vol and asset appreciation over 50 years, but can I get paid today? So how about monthly income? Because my original vision is, could I pay for somebody to live when they're too old to work and they have a life savings? Can I use their life savings to provide that person with monthly income that they can live on? Why is that important? Because their life savings should be there when they die. Wouldn't that be cool? It started with this idea, like I've met a lot of people that are retired, and their fear now is that people live so long that they run out of money. You'd be surprised how expensive it is to be old. And it would be terrible to be 86 years old and you're nearly dead broke. What are you going to do? Work at Starbucks? Right? So you're like, so if they put in the retirement money, can I do all of this, which is the first mandate, lower the volatility, but provide monthly income that they could live on, so that when they die, their life savings is still there. It's still there. Wouldn't that be an amazing thing? You're like, you retire with $1 million and then you die with $1 million. But I helped you live for a couple of decades on the income that I can provide, meanwhile protecting that principal. Like, how would you protect it? Well, you would lower the volatility so you're less exposed to a falling market. You're using derivatives to hedge and earn income. So even if you're retired, let's say you're 72 and you're golfing with your buddies and they're like, "Oh my God, how are you doing? The markets are really down lately, huh?" And I'm like, "Yeah, I guess so. It could be. But you know, I'm doing everything I can to lower your exposure, but I'm still earning the income through derivatives and dividends and other strategies, right? Like lending stock out of the portfolio to short sellers, because you know people are short selling in a down market. Well, I don't want to dump my portfolio, but I can lend the stock to a hedge fund who would short sell it. So he borrows, let's say, $100,000 of General Electric from our portfolio. Okay, $100,000 worth of General Electric stock, but he has to put $100,000 of treasuries in my account. So now the net asset value of our account is the same, but some guy's out there short selling it, and I'm earning 4.5% on it because he has to pay me for the right to borrow the stock from the portfolio. So now I've enhanced the portfolio's income by 4.5%. On that 100,000, or you know what I mean? And so now there's all these different strategies that a hedge fund can do to earn money. And so you're like, yeah, well, the markets are down, but you know, you're not so focused on NAV because you know I'm already doing everything. But pa-ching, you get your, like literally, can you imagine as a retired person, I'm sending you a monthly check. Like a job, like an income, not quarterly, not annually, every month, pa-ching. And I'm trying to get to 1% a month. So if you're retired, let's say every month I send you a $10,000 check. And you got to live on the check. Now, where does that come from? Endowment. So I learned how to manage an endowment. So a museum might have $100 million and they have an annual budget of $8 million. So they're like, Wayne, we need you to use the $100 million and just find the lowest risk way to give us our 8%. We need the $8 million. That's all we need. We need you to pay for your own services. So that's after paying you. We need the $8 million a year, every single year, to maintain the costs of running this museum. We're not trying to turn the $100 million into $200 million. Like, don't expose us to that kind of risk. We need that $8 million. Well, I want to, right? So what you do is lower the volatility, get consistent returns, and find low risk, consistent ways to produce income over the portfolio so that the principal you never touch the principal, and now you're income focused. So you want low volatility to the net asset value plus consistent income. I'm like, this is how, so I could do that for a museum. I can do that for a university so that like Harvard's money lives forever, and 100 years from now, Harvard still has billions and billions and billions of dollars, right? So why can't I do that for a private person? Right? And I'm like, I think I want to dedicate the rest of my life to that. I think that should be done, that somebody manages your money like an endowment, like a charitable trust. But it takes a complete different mindset. Because that's not like why people go to Wall Street, right? The same way most hedge funds are focused on models and bottles. Most retail Forex traders are focused on models and bottles. Making big money, get my paper, get my stacks. I'm like, I want to focus on the meaning of the rest of my life. What is the purpose of the rest of my life? And I'm like, I think I could do that. That is my purpose. So that's where I'm leading to. Anyways, so that's a long-winded way of answering those questions. Jim says, when a trader makes it to the top 5%, what is a realistic monthly return on a Forex account? The best Forex traders in the United States, okay, these are licensed and registered traders. So they are CTAs, Commodity Trading Advisors, okay, managed by the National Futures Association. So the first thing you need is your Series 3. And then you want to become a Forex trader, so you need your Series 34. Okay? Easy peasy lemon squeezy. It's a fun process. Not. Anyway, so you become a CTA. And a company called Barclays Hedge, not Barclays Bank, Barclays? I don't know. Barclays Hedge. They, for many years, decades now, have been tracking the performance of CTAs. So when you go into a CTA, you got to go through all the categories of these funds and traders. And you want to look at global macro traders. Because Forex goes under global macro. There's a few other things like futures, right? So they're really futures traders that are exposed to global macroeconomics and Forex traders, right? So you get there, and the very best, Jim, the very, very best, and they usually don't maintain it long because they have a good period and then they have an average period, and then someone else has a good period and then they go back to an average period. But the very, 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 very best global macro CTAs, when they're at the top of their game, get 2% a month. Okay? So this is why when retail Forex traders come in, they say, I ain't got no money, so I'm going to jack up my leverage because I want to make 20% a month or more. I get this all the time. Like, Wayne, I made 40% last month. I'm like, that's sweet. You're on your way to bankruptcy. But that's a great month. Yeah, that's amazing since the best traders in the world do 2%. So how do you get from 2% to 40%? Better quality trades or higher leverage? How do you do that? So, right, we call this risk-adjusted returns, I guess. Which one, guys? Which one is the better trader? The 2% a month or the 40% in 1 month? Someone that makes 2% a month, let's say for years, or somebody that made 40% last month? Well, risk-adjusted performance, I don't think this is sustainable. And the question is, how do you get 40%? Answer this question. Do you think people got 40% because they did better trades than the team that got 2%? Is it better trades? It's not better trades. In fact, they could be terrible trades. The only way they got that is through leverage. And probably some luck. Okay. And the biggest killer to an account is leverage and vol. So imagine if some guy took 50% of his account and bet it on non-farm payrolls. Okay, over-leveraged, high volatility. Now, if you get right, so you bet on non-farm payrolls. You bet right. Ha-ha, you bet right. Yeah, if you bet half of your account on a high volatility event and you got it right, despite how dumb that would be, yeah, you can make 40%, sure. But you will lose. That's such a dumb approach that you will lose. It's like drinking and driving. You're going to hurt somebody. So, so going back to that question, Jim's like, once you become a consistently profitable trader, what should you be targeting for a monthly return? You should be trading like all the other institutional traders. And remember, the best of the best are doing 2% a month. And you're like, that sounds like nothing. Bro, that's like 15% a year. Your account is doubling every 5 years or less. You think 2% is nothing? You don't get money. You don't understand. What are you talking about? That's crazy good to consistently perform 15% a month. Do you understand? I just showed you the stock market on average goes up 8% a year, and you're knocking out 16. You're doing twice the S&P 500. consistently? Do you understand that money would fall from heaven? You're like the Medici. The Pope would invest in you. You got Pope money, dude. And that's the mindset difference. You could do 1% a month. Actually, that was 1%. I said 15. No, 1% a month is about 14 or 15. Dude, 2% a month is like 34. You're like triple the S&P 500. So like, that's why it's so crazy for someone that will brag about doing 30% a month. They're like, you don't need 30% a month. If you did 2% a month, you are the best Forex trader in the world. The only reason you're doing 30% is you got 30% on a $1,000 account. And you're trading because, right, you have nothing to lose. But you're going to work for somebody someday that has everything to lose and really nothing to gain. They're like, right? Like I was talking to somebody just the other day, like 2 days ago, and I'm not going to say who it was, but they just, I was giving them kind of the talk, and they're like, I'm not interested in capital appreciation. Just straight up. Why would somebody say that? So we're talking about investing, obviously. What did he say? What did he mean? I'm not really interested in capital appreciation. Anybody? Type in a question mark. It's a good way to see the lag. The YouTube lag. He doesn't need more money. This is what he said. When I was showing him, when we were having the conversation about it, he's like, I don't need any more money. I'm not interested in more money. That's what he told me. For his retirement account. I'm not interested in more money. So imagine the disconnect. If you're trying to just make money and you're willing to, gamble or take on a lot of risk because you're trying to turn your $1,000 account into a $10,000 account, well, that would be your focus. You want to make 30% a month. And you're willing to lose the $1,000 because it doesn't matter. You'll still just not have any money. So you're willing to go from not having much money to continuing to not have much money. When somebody says, I'm not interested in capital appreciation, what they're telling you is they don't want to lose any money. You cannot lose any money. It's the opposite conversation. Someone's willing to lose it all to get money, but when you have money, you're willing to do whatever it takes to not lose any money. To the point where I don't need you to make me more money. More money wouldn't do anything for me. But if my money went away, I will kill you. You understand? 100% of the game is not lose the money. But that income puts fuel in the jet. That income, that monthly income, buys the Lambo. So The thing is, if you're going to get bigger as a trader and trade other people's money, you got to get away from the retail idea of it and focus on 2% a month is ridiculously high. And you don't need to make 2%. Going back to answering the question, you don't need 2%. Someone would rather you, if you can lower your volatility, instead of like some months you make 4% and some months you lose 2% and some months you make, and you're going back and forth up, you have a bad month and then you have an okay month, then you have a good month, then you have an okay month, then you have a bad month. Then your annual returns really come down to the luck of the last couple of months. Were they good or were they bad? And it could significantly change the total outcome. So very often what you should be focused on is if you can earn the consistent returns better by maybe deploying a little bit less leverage, or maybe taking less mediocre trades, what happens is you end up not making 2%, but if you made 1.25% every month, let's say on average, because you have less down months and more like decent months, you will probably get a better outcome, especially a risk-adjusted performance, because you're going to have less volatility between peak and valley. And because of your conservatism with leverage and investment choices, you'll get a more consistent outcome and you'll attract more money. But different game, right? So I'm teaching you the techniques to survive in the beginning. And then as you advance through your career, I'm trying to change the mindset so that you can take the tactics that you learn in the early days of trading, which is like trading moving average crosses and your waves and buying at certain pivot points and selling at other pivot points. Those are just tactics. That's cool. You got to be really, really good at that. But then later you need to like formulate a strategy first and then use your tactics. And then once you got all that down, then there's like portfolio construction and fund management. Okay? And once you get there, you look, that's going to take longer than 6 months, right? But once you get there, I think you will find that you're patient and disciplined, and that leaves you to lower volatility and consistent returns because you have lower volatility. Your patience and discipline. You're patient and you're disciplined. That in of itself will lead to lower volatility and consistent returns because that's you. You are less volatile and more consistent. Yes, that would be, yes. Favorite monthly, but very often, okay, very, very often you're paid quarterly. So you can do it both, favorite. And I know it does change the outcome. But you probably want to get paid monthly or quarterly, right? And so you pull your fees out, and then that gets, you have gross and then you have net. And of course, your clients want that 8% a year, right? So like my thought, going back to managing personal endowments, is even if the stock market's down this year, let's say we go through a recession and it's like 18 months where the stock market is kind of falling and basically generally negative because we're in a recession. Recessions are normal. So your net asset value is going to fall. I would like your net asset value to fall less than the S&P 500. So if the S&P 500 is down 17%, you're down 10%, let's say. 10 to 12. The stock market is down 15 to 17. So you're better off. It's lower volatility because I manage the beta appropriately. If I can hedge, I might be able to get that down more like 8. So wouldn't that be great? You have half the downside. But that's not my prime directive in that situation. I do want to manage the risk and I do want to protect the portfolio, but ultimately I still want to pay you your 1% a month. Imagine like collecting somewhere between 8 and 12% a year in income. Even if it's a down year, stock market's down 15 to 20%. Well, you're only down 10 or 12%, but you still collected 10%. So now you got the income in your pocket. As a total return, you're only down 2%, and the stock market's down 15 to 20. So now you're actually, as a total return, only down 2. But you can't live on total return if you're retired. So you're like, okay, so your portfolio is down 12, way better than the general stock market because I hedged you. So you're down 12, but I paid you 10% money in your pocket, in your bank account, so you could pay your mortgage, buy groceries, go on a vacay, right? Your medicine's paid for. And it comes in and you're actually at that point as a retired person taxed like you got paid from a job. It's like a salary. You're living off 10% a year, but that I just explained how that's how museums run. They have a principal amount of cash sitting in an account being managed by a hedge fund manager. And the idea is, please, God, give us the 8% a month. 8% a year. And the museum can run year after year after year after year after year after year, as long as that 8% comes in. So you don't want to lose the principal, because if you have a 20% decline in principal because it was a bad year, now the next year you're going to need 14% return to get the same amount of money you need. And all of a sudden now you got to take on quite a bit of risk if you're going to get 14 to 15%, plus you got to pay the hedge fund's going to take money. So now the hedge fund has to earn 16 to 18%. You're basically now going for 20%. And the stock market only moves 8, so you either need to get lucky on the beta, which is the market just happens to go up, or you got to increase risk, which means there's a high probability they come out with a negative outcome, and the 800,000 or 800 million, or whatever, 80 million now drops to 60, and now you just ruined this institution. This public institution has been ruined. So instead, they're very focused on lowering risk, lowering risk, lowering risk, lowering risk, lowering risk, and earning income so that the museum can run for the public forever. And I'm like, well, that's how money should be managed for those in retirement. So you got to have all of that put together. And 1% a month compounded is not 12% a year. Compounded is closer to 14%. So when I'm asked what should people expect to do? Well, if you can get it down to 2%, that's way crazy. You could drop it down to 1% and be a very, very, very good money manager. How good? Well, Bernie Madoff raised billions of dollars from very sophisticated people. And of course, it was all lies. But what was the lie? Does anybody know what he showed on his fake trading account to get people to invest billions of dollars? These were very wealthy families. There were institutional investors. What was the lie that was so good, so attractive, so unbelievable that people invested billions? Does anybody know? The Bernie Madoff's BS monthly returns? 1%. Jim nailed it. 1%. But every month, it didn't matter if it was a good year or a horrible year or a mediocre year, Bernie Madoff found a way, no matter what the market conditions, no matter what was going on in the world, crisis or boom or bust or bubble, it didn't matter. He always, without fail, produced 1%. And he attracted billions of dollars. Many, many billions of dollars. And so if you're going after 30% a month, you're not interesting to people with money. So if your goal one day is to manage other people's money, you got to create the right story. You got to produce the right returns with the right kind of trade history, huh? So I hope these conversations on portfolio construction you find interesting and instructive. And then I hope you take some of these thoughts, and if you can't apply them to your account now, at least you're learning and you're thinking about maybe a new way in which you would like to trade in the future. So some of you might say, look, Wayne, honestly, that's great, but I really don't have a lot of money. Well, hopefully you have more than $10 in your account. Okay, so if it's a couple of grand and you're like, I want to turn this into a business, well, it's going to take you time. And if you want to achieve the results you're going for, okay, you do need to eventually trade the way that I'm preaching. But you might argue, well, Wayne, I'll turn my 2 grand into 10 grand and then I'll start. But the problem is you're taking on all this extra risk when you're at your weakest as a trader. And you're like, Wayne, what do you mean by that? All right, well, compare yourself. If you were able to sit here every single day for 10 years, you will be way better as a trader 10 years from now. But what you're telling me is you want to take massive risk now when you have the least probability. So what you're kind of telling me is if you can take higher leverage trades and get lucky, probably betting on sort of more volatile markets. So you're short term, you're less experienced, you're taking high risk, and you're like, well, Wayne, I'll grow my 2,500 into 10,000, and then I'll become patient and disciplined conservative. Well, good luck. I hope you do it. So, peace on earth. May the pips be with you. May your profits be above average. Thank you for being part of the community. Click the thumbs up on your way out. Leave a comment under the recording. Check out all the links in the description. Thank you for being here. I will see you soon.